The U.S. financial markets are highly levered, and that leverage is unwinding without value considerations. ETFs, when sold, sell everything. Still wait for this falling levered knife to hit rock bottom. Next week may present opportunities. I couldn't think of a better way to start this video than this gentleman who's best traders of all time. S&P 500 breaks its August 5th level. Nasdaq teeters on the August 5th level after the tariff reveal. China is the first to play hardball and retaliate. Why the dollar is the #1 market you need to be watching for stock traders. We have a ton to go over. Let's get into it. Now, in front of us is the S&P 500 and several breadth indicators. This is the 200-day, the 50, the 20, and the 5. And what's so fascinating about this is it tells us exactly how many stocks per each one are below that moving average. So in other words, this is telling us that we are roughly 21% are above their 200-day moving average, and then down and down and down. So just for point of reference, 21% of all stocks right now are above their 200-day moving average. Roughly 11% of all stocks are above their 50. 5% of all stocks are above their 22. And then down here, approximately 1% of all stocks are above their 5-day moving average. So what we're gonna do is take a quick snapshot of this line by line and show you how these events have played out in the past, so you can have an understanding of how this is going to play out in the future. I think it's important to take a long-term outlook and a short-term outlook. So here we are, and what we're gonna do is we're just taking a look at 10 years, and we're gonna drop a pin from exactly where we are now and look at those levels. And then the easiest thing for us to do is take a look and say, all right, I understand where we are in the 200-day moving average, and go from there. And what does that mean? It means looking at this, all we're doing is marking off location, and we're saying to ourselves, well, this is where we were before. And then we would also have to take a moment and say, we have to be aware that there are times when it's gone lower, substantially lower, where you've actually had readings back here on September of 8. So can this go lower? And the answer is yes. But what we have to do is say, all right, how many times have we been here in 10 years? And we'd have to say, well, we did it here, and up and down, testing that area over and over again, but then eventually lifting and going higher here. Right, and this was obviously, just so we're clear on what this was, this is when we had a little bit of a tariff spat in the past with Trump 2.0 or 1.0, as they like to say. And this is a little something where we had that nightmare of the pandemic, and we could see these V patterns. So if we're trying to understand this, I think the best thing that we could do is look at this from the standpoint of what did we just do? We created the scenario that we had in the past. So what I've done is I've cut some headlines out that we had during that period of time that I just highlighted. And we can see Trump's tariffs may imperil a delicate global economic rebound, and that U.S. tariffs should trigger a chain of retaliation. Trump imposed tariffs on steel and aluminum, raise trade wars. An economist says the tariffs will drive steel up and aluminum. Those industries may employ people. This is really big concern. Trump trade war could make the Trump recession a reality, 2019. Trump blasts at home and abroad for imposed steel and aluminum tariffs. So we've seen this. Now, it's not the same thing. Let's be really clear about that. And I'll show you why it's different. So Goldman had this really good piece, and I just wanted to show it. And it looks like they were using someone called the Global Investment Research Department to put this out. But I got it from them, but that's where they're stating this data is from. So their base case before this came out was 15%. They're actually higher. They're actually closer to 18, which actually does put you up here back to 1930s and 40s. But you had an issue before that with the stock. A lot of people say, well, this is what caused the great financial crash. No, it's not. So if you go to 2018, this is where we were before. Okay, this is a little bit higher than that, isn't it? And so we have to understand that I'm not fully comparing apples to apples. Statistically speaking, you need 30 dots. I don't have 30 dots. We've only had this guy in office twice. This is what we have. So we have to go on the data that we have. So we can say that this is worse than this time, but we don't know the effects of this yet. And I think the effects are going to be much different than people think, but we'll get there. And in just like we saw before, in November, once he was elected, everybody went crazy. Animal spirits are back, we were told. Yardini, 10,000 on the S&P. Everything's going crazy. We have to get involved, and you better get involved right now. And remember these rips that we saw in the market. So when you start seeing these headlines again, recession this, recession that, these are the same group of people that were telling us that the market was going to rip. So you have to look at these headlines with a grain of salt, and you have to look at the economic data. And when I'm saying this, I understand that this is obviously more significant than 2018, But just look at it as a whole as we go forward and look at this data set. And it's not like he didn't telegraph to the world that he was going to do this. Everyone will remember when Trump told Davos he wants lower interest rates across the globe and I want lower oil prices. And this was January 24th. He was in office for 72 hours, something like that. Davos, Switzerland, January 23rd. Trump demands OPEC lower prices. What did OPEC do? It lowered prices. Interest rates in a speech, Global Political, warned them they will face tariffs if they make their products anywhere but the US. He's been saying this for months. I will demand interest rates to drop immediately. I'm trying to say it with a straight face. Likewise, it should be dropping all over the world. Well, they're going to drop now, aren't they, all over the world? I'm also going to ask Saudi Arabia and OPEC to bring down the cost of oil. They did that. So it's the idea that people are absolutely surprised by this, even shocked, I really don't understand. I want to be clear about what I'm saying. I'm not saying that I agree with this math. I'm not saying that at all. But this is the hand that we're dealt. And we can all argue that this is calculated wrong. But you know what? We're not the ones making decisions. So if this is how they're going to do it, then this is how it's being done. And we're better off not tipping over the board, but understanding that these are the rules and playing by them. And I just want you to understand all this before we go back and look at the technicals. And people are going to be like, well, why don't you just get to the technicals? Because if you're just looking at technicals right now, you're getting destroyed and you don't even understand why. Here's what I mean. When we look at the market as a whole, we look at our stool and we like the stool and we're going to go there. We're going to go back to the stool. We're going to bring this in. We're going to bring this. And we have our macro leg. If you don't understand what these tariffs are going to do to every single industry on a fundamental basis, so you have this macro event, which obviously is our liberation day of tariffs, apparently of profits. If you look at this and you go, well, it doesn't matter. No, this matters. Your little chart doesn't matter. This matters because your chart's changing based upon every single one of these. So when we look at the macro, we look at the fundamentals and we look at the technicals. And then we look at this and go, well, what's going on? Well, we have these numbers over here that are basically imploding the entire market right now. Okay, who's affected by this? Well, we have the XLY names that are affected. Retail's affected. Okay, well, retail's affected because of China. Well, who makes shoes? Well, Nike makes shoes. Well, where do they make their shoes? Well, they do it in Vietnam. All right, well, what's the tariff reciprocal rate right now? 46% there. All right, so when you're looking at the macro, the fundamental, and the technical, and you're out here saying that, oh, it doesn't matter, I just look at the technicals. And then 46% has the potential to become zero in the middle of the day, and you don't understand why something's happening. For example, you could be short Nike all of a sudden, and it looks beautiful, it gaps down, it's at 52, you're doing cartwheels, and wham, stock spikes up over the short, completely over the previous close. People have no idea why. And they're completely shocked as they get run over. And that's why when we look at this, we look at everything. It's why we understand that it's important for us to, when we look at this data and we dig into this data, to really grasp why what's happening on this chart is actually happening. Because when other people are shorting that and you know that that piece of data is so important, you can actually go long and profit off of it. All right, let's get to it now. Now, in regards to how to use this data, I find comparative analysis the best. And so that's what we're going to focus on this morning. I just think it's better off, and then we're going to really drill into it. So let's do it. If we start with the 200-day and we just do the simplest of things and we mark it off, what we're going to just see is other areas of interest. And those areas of interest we could say a lot of things about. For example, like, oh, well, that means it's going to get worse, or this time it did this and this time it did that. All we're saying is if then. So it's almost like a statement. If it got here, then what happened? So I'm going to just go over here and just, you see how you can click lock all drawings or keep drawings? And I'm going to point stuff like this out because people always ask like, hey, how do you do this? If I just go here and highlight these little areas over and over again, and you can see them here as well, it's not rocket science, right? It's not telling you that you're just everything's great and everything's going to be fine and all your dreams are going to come true and you have nothing to worry about. That's not what I'm saying. And you understand now that just by looking at technicals, it's not enough. Anyone that's just looking at technicals or looking at a VWAP or looking at anything like that, and I want to be clear about this. It's not directed at anybody, but anyone that's just saying, I'm just going to look at technicals and not pay attention to what's going on macro or fundamental and not look at that, is like, good luck. You know, it's a disaster. It's an absolute unequivocal disaster to think like that. So, of course, here, for example, you bottomed. Why? Not because of technicals, because you had a complete, utter change when the Fed said, hey, by the way, we're going to print $1.7 trillion. And you had one of the greatest runs of all time where you hardly had a drop in the market. Once you get this and understand that, oh, this is where you had peak inflation, it just starts making your life a lot easier to understand that there are actual consequences for the things that happen. Oh, you mean you're going to do what? You're going to stop raising interest rates? Like, it's not rocket science. And so, like, if you look at this going, oh, okay, you have this plan with tariffs, and now it's a week later, and that plan, now you have negotiations. Oh, okay, I got it. Or, oh, you put your plan in place, you have negotiations, and they went nowhere, it got worse, and we have retaliatory tariffs. Oh, okay, that's why you dropped, and that's why you're at these levels now instead of that level. So what this means is this is a level of interest that we look at and we don't judge it. We just pay attention to it, and we understand that there will be a macro event that is going to help us understand where we are. In the meantime, you will have bounces, and we're going to get to that today because you had a massive bounce on Friday, and nobody got this. So nobody really understands why. We're going to talk about it. But what we see here is we see a level of interest that is pretty important. You know, when you're at this 1920 level, this has been an area over the past 6 years. And if we went back further, you're not going to see it too often. Matter of fact, when you go back 10 years, you've only seen it a handful of times. And again, I can go through more and more metrics like this, but for our standpoint, this is a level, it's not a trough level. I'm going to be very clear about that. Trough levels would be, well, what was the lowest level on reading? That was absolute puke level. And these breadth indicators are about as important as it gets right now because everybody's watching them. But when you had a pandemic, for example, you were at a 2 at one point. It was insane. And then you go back here and you say, okay, well, where were we in 23? Are you at an 11? That means you could watch another, and you then extrapolate out what it means. All right, I could watch another 10% of these names in the S&P break. That means 50 more names could break their 200-day moving average. Right? When you get what it is and you understand what you're looking at, it makes a huge difference. So this is a level of interest. Does it mean you're going to bounce? No, it does not. It does mean that we should certainly be paying attention to it. When we go to the 50, and the 50 is the one that most institutions watch. And the reason for that is because they want to look at it and say, hey, what's Bob doing? Are they getting in? Are they not getting in? It's that kind of level. It's what are the other funds doing? Because institutional support takes place at the 50. So we're going to have to get rid of that other level in there. What we'll do is, let's clean all that off for a second. We'll take this off because we're just going to drop one line. And we'll just put that back in. And then, again, we're just going to do the same thing. Maybe we'll do it with the arrows. That seem to be a little bit better. Just experimenting here while we're doing this. But if we look again at these levels, all right, well, yeah, it's the same. Well, not really. No, it's actually happening more. And that's the thing about this. Why would this happen more? Well, it's a lower moving average, Rocky. It's not rocket science why that would happen. I mean, look where it happened here. So when we look at it that way and go, yeah, it happened here and then we bounced and then we rolled back over because we made a lower high. And even though this made a higher high, we had a little bit of a divergence there. And for those that are in the community, they know that this is when we actually got out of tech. Not out of everything, but we got out of tech just because it didn't feel right. There's some other stuff pointing at as well. I won't bore everybody with it in this video, but I may do a video on just how to spot tops or how the potential to spot tops because nobody really knows. What is this telling us? We're oversold. Could we be oversold more? Yeah, but you're getting to that level where it's a falling knife. And you're getting to the level where we're getting forced selling. And forced selling is always the last selling. And think about it, it just makes sense. Because why? People don't want to sell. They're being what? And so therefore, if you think about it that way, the people that want to get out are going to get out. And the people that want to stay in are going to stay in. And you're like, wow, this is really important. It is, because once they're gone, there's nobody left to sell. And then you get these kind of V bounces. Now, most V bounces, and there's one out there, we're getting to it, but there's definitely one out there. There's just no way around it. Most of them are vicious, but most of them retest. And what I want to show you is that's not the case with what we've dealt with before. And so when I'm seeing something like this again, and we go, okay, well, I'm at a 5 on the 20-day. Well, this is absolutely huge to me that we're at a 5 on the 20-day. Because if I look here, well, we were there on December 17th and we bounced. We're here on these little ones, April 17th and we bounced. Okay, and you start going through them, there's bounces out here when we get to these levels. And that's really important. It doesn't mean that it happens all the time. You can go back to here, but you certainly see that it happens more, and it always happens more when you get to those what? Lower moving averages. So this would be more of a short-term to medium-term indicator. But when you're getting to the point where 95 of all your stocks are below your 20-day, you're getting somewhere here where you're like, all right, well, we're at pretty much puke level. And this really gets me to what I think is like my favorite for this particular time is when you start looking at the S&P and you're looking for these 5-day moving averages. When you get to this, and you just have to think about it this way, when you get to where you're at, where I think we're at 1% is where they have us. They actually have us at like 1.59. I don't know how you get a percentage, but whatever. Let's get rid of that for a second because I don't want all those on there. I just want you to see the one clean. And we just drop that right there. Boop. Would have been better if the noise and the line went at the same time. And then you go, all right, so what is this going to tell us? And this is what I think it does tell us. I do think it tells us like, yeah, there's a bounce out here. For how long that bounce is going to be, we don't know. That's more correlated, but we're going to go to this one too, because what I want to show you is why, and I want to show you these three. And we can go back further. It doesn't really matter, but I want to show you why you care about those 3 or 4 and what the difference is, because one gave you a real clean sign and one did not. So if we look at these areas that I just marked off, we'll have to get rid of this. It gets super aggressive. We look at these areas we just marked off in here and why this one kind of worked and then why it kind of rolled right back over, why this one might work, why it might not, why this one worked, and then we lifted higher. So you go up from this. So then what I mean by that is going, okay, well, we know here that we all have a 1. And this is why you want to pay attention to this, because this is really, to me, it's very important. And then because you can understand why some of these are going to work, why they're not. So if you go here and you're like at a 5 and then go, okay, well, that's at a 5 too. And then this rallied right back to an 84. All right. So when you go and look at them and you're like, okay, well, we're around that 8.5 level again. It doesn't have to be exact. And then you can look at this one and say, okay, same thing. All right. So these all had the 20-day aligned with them. And yeah, we have not bounced yet. And we don't know that we are going to bounce. I want to be really clear about that. We just don't know that. But what we do know is we do know that these all being correlated are very important. And focusing on these 3, just to get to the point, if you see where you're at a 1, which you get to these levels, and it's pretty incredible when you're down here. It means 99% of all stocks are below their 5-day moving average. And once you get to that, this is what you really say. You get to this point where, all right, is the 20 going up? Is the 50 going up? Yes. All right. So then I'm getting underlying support. Remember how I always look at these lines? I always say that this one means, are the bulls in charge? Are the bears in charge? Is there institutional buying? Do I want to be doing a swing trade here? I use a 12, a 22, and a 55. This data is based upon a 5, a 20, and a 50. You should use what you're comfortable with. So once we get this and we say it, I think that you should be able to really hammer out the difference between a huge spike up and then underlying buying of the market, which you did not have here, versus this, where you had a huge spike up and then underlying buying above the 20 and the 50. So when we bounce, and I'm just going to be real clear about this, if you think that you're not going to bounce at some point next week, that's just outright delusion. There's always a bounce. It doesn't mean it's sustainable. It just means there's a bounce. It's very clear we have a trend. We've gone over that ad nauseum, and there's always counter trends to that trend, right? We know this. And I'll give you another example in a minute here. But what we want to understand about this is if we bounce, what we want to do is take something like this and say, do I have this where the 50 and the 20 are not moving? Or do I have this where they're piling in and they're buying at the 20-day and they're buying at the 20-day and they're buying at the 50-day? These are two very distinct situations. One stopped you at the top of a control bar and you really never went anywhere from there. And the other started a run that lasted for months. There's a huge distinct difference between the events. Now, what's going to do this here is, I'll be real clear. Do you get clarity on tariffs or do you not get clarity on tariffs? That's going to be what it is. And we saw some signs of that on Friday and how vicious this could be. Now, this core concept, before I get into, I just want to be, again, and just point this out. If we just do the simplest of things, here's your trend line. If you use these points, great. If you don't, some people don't use them. They only want to use the actual, they want it up like a little bit more. But it is what it is. I'm going to leave it there. And then you can see here, and you can see the attack. And we talked about these levels ad nauseum and the 5 points of contact between the support lines and dropping in our VWAPs. And we talked about the fact that if you had like 5 pieces of confluence here, which you did, that you had a real problem up here. If you guys will remember this, I'll just drop it all in. There's the 200-day, there's the 2 moving averages from here to here. And the more stuff that you have in an area, the more at times you're going to have a problem with it. That's actually down here, sorry. It's actually the gap fill from the November 5th. And then at the time, the 22-day was there as well. So you had like 5 pieces of confluence. You hit that. You also had this, obviously the trend line, which gave you 6. So what I'm about to say, when I show you this, no one's looking at this and saying, oh, we're definitely going higher. That's not the point of this. Obviously, we're going to have the super scary death cross. Ooh. But what we have to understand is where we're at. And this is why I always say moving averages are lagging indicators. And if you're waiting to trade off of them, half the time you're going to miss the move. You'll miss the meat of the move half the time. I mean, imagine not shorting until you get a death cross. Could you imagine that, right? Or not selling your swings until you get a death cross. So anyway, I'm going to show you what I mean when I say trend and counter trend or contra trend. So we obviously had our liberation day and everything just was fantastic, right? And then we gapped down 4% on the day. From that gap down, you have another move. And that move is to here from that high, and that gets you another 1.7%. Right around 11 o'clock, you get a counter trend, and that counter trend, or contra trend, however you wish to say it, bounces you 1.5% in the market. Now, this is what you have to realize as a trader, no matter how you're trading. That bounce out there is a measured move, right? And that is telling you moved 1.5%. So again, what I tend to do is look at the bounces and then see how strong the bounces are. And that usually tells me what's going on. So this first bounce was kind of like, and that's a decent bounce. This is why when everyone's telling you, though, they're holding their puts forever, they're just not being honest. I mean, no one's going to hold, and if you do, you're just going to get run over. But if you're holding puts, you gap down and you're still holding the puts here, you know that the gamma is going to throw you off by here anyway. But and you're saying I held and I like, okay, you're just waiting to get run over. That's not how any of this works, by the way. So next thing is when you get to that, look at this level. And you see that level, that 437 level. All right, so we got back to the open and then we rejected. Everyone's like, ooh, we rejected the open, they're still selling. Correct. But look what happened here from that low. From that low up, you had a 2.7 move in the market. If you're trading and you're a long trader and you're getting a 2.7% move on any given day if the market was strong, you're doing cartwheels. And what you're getting is you're getting a level of volatility that is easy to trade in a market like this because it's going to be vicious when it bounces. And it's going to be vicious because of all the breadth indicators that we just went over, but I'll give you a couple more as well in a second. So you have to ask yourself a question when you're shorting. Are you willing to go for 2.5%, 3% bounces on these names? The answer is you probably should not be willing to do that if you're in the short term. If you're long-term buyers or long-term sellers, then you want to get out, right? If you're into these if you're trading. And that's really important for people to get. I don't think a lot of people are getting this. I think they're getting, oh, I'm just going to short and I'm just going to leave the short on. Good luck with that, because this is what's going to happen, and this is what people need to understand. Something like a Nike, everybody's short, everyone's like, it's going to zero, it's going to be a mess. 1 5-minute bar in this market erased all of your gains. All of your gains that you were short from here, all your puts that you were holding next week, they've gone away. Just like that, 1 bar. All because there's one conversation with one phone call that says, oh, we might do 0 tariffs in Vietnam. And what did that do to the market? When you start to go through all those names, how did they respond to it? Well, they ripped everybody's face off on these moves. And you can see it, even Restoration Hardware, okay? Even if like all of a sudden it's just like, oh, we're just gonna, that's it, it's over. And now you're gonna have the people going, oh, well, we're definitely gonna roll back down. Really? Where's your stop? So all that work that you're doing here where you're short, and this is the really hard point for people to wrap their noodle around. This could still be a problem and still affect corporate profits. But now you're dealing with sentiment. And sentiment has flipped probably to one of the lowest levels that we've seen. I think fear and greed was at like a 5 or a 6. You guys can look that up. But when you start having moves that are going from 237 to 264, and you're up here saying, oh, I'm going to short again, you're just waiting to get run over. Because you still have these news cycles that are going to cycle through where now he's going to come out and save the day, and I had a phone call and they're going to do this, and we're going to talk about how great things are. The rhetoric needs to get to a point that it becomes favorable. And it's just not there yet on a macro level. But micro levels, you're starting to see it under the hood. The reality is also starting to set in a little bit here, and I really want to hammer this point home again. I think it's very important. There's this idea that money is flowing into Europe. Here's Europe. Does money look like it flowed into Europe? All right. So I heard a bunch of analysts talking this weekend about how the money, massive sums of money are going to Europe. Really? Someone should tell Europe, because it's not happening. Or all this money is going to flow into China. Really? They retaliated. And no matter what side of the aisle you're on with this, the pro-tariff or the other side, I don't know why people have to pick sides. It's so weird. But no matter what side of the aisle you're on with this, what China did is not constructive, period. I'm not saying that what the US did was constructive. We've seen what that did in the market. But the stance that they took is not constructive. No one's thinking about if these other little southeastern countries over there, or these other countries over there that could be way more nimble, I should say it that way. What if they're like, yeah, we'll do zero tariffs. And then all this stuff over years, and it would take years, starts moving to other countries. Like this, for me, with what China did, solidified what we saw. And I'll show you what I mean by that. Now, if we look at the US dollar and we say this was Inauguration Day, which it was, we all know that, and we had a speech. We had a speech on tariffs. And they start selling the dollar down on that day. So we have the dollar. We know that this is where it is. And I'm going to try to explain this as cleanly as I can. Everything revolves around the dollar. Everything. When you have European banks and they are buying our equities, I'm in the US, so they're buying our equities. They're buying US equities. And they're buying them for reserve currency. So in other words, when they're buying the Mag 7, they're not only buying it because it's going to be stagnant, but even if it goes flat or down a little bit, they don't really care. Why? Because at the end of the day, the dollar is going to go up. And if the dollar goes up, like it does here, like you have from October on, and they convert back, they're still making money on the conversion rate going back. So when we look at other currencies, and I'm not going to get into all the currencies, you can look at this versus the dollar or whatever. It's just easier for me to use the DXY, which is a culmination of Japan and the euro, etc. But you can break it apart. You can do any one you want. So even if they drop a little bit, they don't care because the dollar is going higher. But when stocks are dropping and the dollar is dropping, well, that's a completely different conversation for these guys. That's when they have to get out of the way, not in the way. So you can see right here, he gives the speech, tariffs, right? More tariffs, tariffs for everybody. Now let's take a look at very specific charts from that period of time, and you'll understand why I'm bringing it up right now in this video. And I wanted to say something, because if you're watching these videos, the only people that really love these videos are the people that want to learn and get better, that want the education and information that actually matters. So there are concepts in here that I inundate you with, and I do it on purpose. You're going to want to watch parts of this over and over again to get the concept, or some of the things that I put in here. I can't stress that enough. So what you'll see here is like, here's the Magnificent Seven, and that's his special speech, tariffs for everybody. You get a tariff, everybody gets a tariff. And then you just look at the dollar, and just drop the dollar in here just to look. And you'd go, okay, well, from that date, and you would just look right here. All right, so we were here and now we're here. And then all you would do is just go, well, what happened to the Magnificent Seven since, the tariff inauguration? All right, well, we're down at 26% from that date on the Magnificent Seven. All right, cool, I got it. And that ties us into some of these levels that we actually, we're talking about on Thursday's video, where we said that, you're probably going to retest that August 5th level. But nevertheless, understand that when you look at the dollar and you look at how this is playing out, it all aligns perfectly. Well, that's probably a coincidence, right? Aha, let's go take a look at the cues. I'm playing around with different watermarks. Tell me how you feel about this watermark versus the big one. The big one's kind of, it's just in your face. I'm not a fan of it. I'm thinking about going back to something like this that has the date in it, the time of the chart is in, and what's there. So any comment on this is greatly appreciated. Okay, so here's the here's our special day. I was going to say pandemic. Here's our special day again, the inauguration. And then, of course, it's funny how that just ties directly in with Itchy's special day on December 18th, right? Which is what? The day where he cut rates, and he's like, I don't know why I cut rates. We just did. Which was probably single-handedly the worst speech ever in history. I actually think he's on his way out. If you look at that level, that's where we got to and we rejected. So we got to a resistance point that we couldn't get over and over again, all from that level. But at the same time, what marked that? Well, that was the decline. Hands down, it's the decline of the dollar. And it goes back to institutional European and Asian equities that don't want to lose money, not only in the dollar, but they were using it to move money over here because no matter what, we had a stronger dollar. So then you go and take a look at gold, and everyone's like, oh no, it's the central banks. Everybody's buying gold. Here's Inauguration Day. And if you just watch this play out super quickly, and look at what's happened since that date, you have had the biggest run ever in gold since 1986. It's the biggest quarter gold's had since 1986. And what people don't understand is, why is this changing? And then we go back and look at the dollar. I can tell you why it's changing, and we're getting there, but I really want to just inundate you with this so that you get it. So here we are again on the dollar. Okay, well, there we are on inauguration. All right, tariffs, itchy special day, spend a little time above it. Now we have, you guessed it, tariffs. And I'm not saying it's not a dumpster fire. It is. It's a dumpster fire floating down the river with a bunch of freaking raccoons. It's a nightmare the way that this was played out. No matter what side of the aisle you're on, this could have been handled better than just holding a board up like that dude on the corner. So I don't think anyone disagrees that this could have been handled better no matter what side you're on. So let's get that out of the way, but this is what we're dealing with, good or bad, or no matter how you feel about it. Here's FXI on large China names. They're breaking out when? Oh, right around here. I think this is roughly, that's that Tuesday. It should actually be over a little more right around here. And you'll see from then, all you did was use that level and then just lift and lift. And since then, you've been going higher. Now, what did they do? Well, they instituted what? Their own tariffs. They retaliated. So what's going to happen to their currency? Oh, it's going to drop? Oh, I wonder who's going to benefit from that. I wonder whose currency went up on Friday. Anyone have a guess? Bueller? All right. So Friday, the dollar goes up. If the dollar stabilizes, everything I just went over will start to find a level and no longer be a falling knife. Once the dollar stabilizes, that's what you need. You can correlate all of these drops that I just went over with the US dollar. But wait, there's more. Here's where you are on the commodity side. Commodities peaked when this happened with the dollar, and now we're dropping even more. I do think on the commodity side, you're overshot on gold in areas like that. But what's going to start happening to lumber prices with home builders? There's a whole thing here, and what you have to do with it is you have to start watching the dollar. We were literally watching the dollar Friday and day trading tech stocks off of it. I mean, that's how strong it was off the open. And of course, you're going to have the bifurcation. And I need to get into this bifurcation and why you're seeing it. The bifurcation between the dollar and what happened with tech, because it's there. So in other words, I'll show you what I mean by this. Super important to get this. So if I look at this and I go, all right, well, here's the mags, and you're telling me about your super special, way that this is supposed to go, right? And here's the mags. And then you're looking at this. Oh, let me just mark from 9:30 on, from that date over. So we'll just go from there. And the dollar's rallying. So this is rallying, and then you're getting the volatility. Why did we sell down? Because there's different kinds of selling that's going on. And this is really important for us to go over. A second to walk through mechanics. Like, how does this work? So in front of you is selling and the rate of which selling will accelerate. In other words, when people sell, when the market drops, why is it dropping the way that it's dropping? So what you have here is insider sellers, and the market really doesn't move. They're usually selling when they think that things are getting peaky, and that's why people watch insider sellers. And that's really important to get. Could it be a canary in the coal mine? It depends. Sometimes it could just be options that they're exercising, or a lot of their net worth is tied into it, so they just constantly are selling. But there are outsized moves. The way to look at insider sellers is not if you see one, but if you see like 17, 18, like when you start seeing the number of sellers, that's, to me, more important than anything. But that's how selling starts. Institutional sellers are next. And for our purposes of this video, this could be anyone from a pension fund to a guy that's running $1 billion hedge fund. For our purposes in our video, we're going to keep it that way. You could break this down into divisions. But here, the selling doesn't pick up. The selling starts picking up when it's institutions that are doing it. And that's really important to get. Now, next, we have retail sellers. And retail sellers panic. Remember we look at smart money, dumb money, and we always say that smart money moves slow. It's really institutions. That's why we changed the names of those. Institutions move slow, retail moves fast, right? Retail's like, I got to get out, the sky's falling. And institutions are looking at equity risk premiums, et cetera, and retail's like, they're a little panicked. They just are. It's just the way it is. It's always been that way. And then there's a fourth group, Mr. Margin Call, forced sellers. Now, it is my belief that that's what we started to see on Friday. And I will show you why I feel that way. But this is the tail end of the selling, not the beginning of the selling. This is what we saw on August 5th when they have to unwind trades. It's my belief that with the dollar spike that we just went over and the way that they're selling certain names, that they are selling anything they can to start meeting margin calls, to start holding certain names. The acceleration to the downside and the lack of force that we saw in buying showed that pretty clearly to me. This is how I view it. And this is the speed in which I view the movement. It doesn't mean you go up when they're done, but it does mean that everybody, and I mean everybody's exhausted. These people are forced to sell. That means that there's no rhyme or reason to that level. There's an excellent book called When Genius Failed. And this was one of the trades that actually got them clobbered. And we actually did really well with this. This was 98. We actually bought this after the dust settled because it made zero. So there's this huge merger going on and they're going to get bought by a company called Tariffs. Well, they lose their contract. This company lost their contract to AT&T. And so what happens when that happens is the doubt Tariffs is going to buy it is going to happen. So you have this huge arbitrage trade put on, very similar to what you just saw happen out there with, on August 5th with Japan yen, etc. So you have this trade that's put on because everyone's sure it's going to merge. And so this stock's at, July 21st, you're at 323. And then the news hits that the merger's not going to go through and that there's some problems out there. And then they see that there's an unwind that has to take place. And that unwind has to take place on the merger on this day. Well, the day of that, it goes, you're down about, 250 in no time. So if you're highly leveraged trying to pick off pennies, now you're margin. So once that kicks in, that's it. And then they keep unwinding and unwinding. And then from that level over to here, in another 2 months, this thing's down to $25. It's completely puked out. And look what happens from there. It goes higher. And within a couple months, or let's call it a year actually from that point, it's about a year from there, 25 to here, you're up 10x. Why am I showing you this? There's a point to it. Forced sellers are like the Terminators. They can't be reasoned with. It's margin calls. They just get out at any price. They just don't care. There's no rhyme or reason. Their phone rings around 2:30, 2:40, and it's like, hey, what are you doing here? And that is the investment bank calling these huge institutions saying, hey, you're over margined. You saw this coming. What are you going to do? Or we're just going to force your sale. We're just going to pick things and get you out. And sometimes they'll avoid the phone call. You'd be shocked by this. And they'll just liquidate. And they don't care about the price. It's all about just protecting. Really important concept to get because that's where the opportunity is. And I think that's where we're going. I think that's where we're at, quite frankly. So when I see things like PM completely imploding and having their worst day on record, this kind of stuff I want to pay attention to because it was. So when I see them having their worst day on record, PM, ever, this was such an easy trade on Friday, and it wasn't because of forced selling. And it wasn't just there. It was MO. It was anything that these guys, whoever they are, had. Anything that they had out there that had any kind of interest rate sensitive, they couldn't get out of fast enough. And to me, this is the easiest trade in the world. And people don't follow this trade. But what you do is you go long this lower beta. So you go long AT&T, you go long Verizon, you go long TMS, you go long PM, you go long MO, these names. And they combine, they throw off a dividend. And then out of that dividend, you get the low beta trade, which is your defensive trade. This is a big ARB trade or I guess we just call it ARB. It's not really, but it's a big levered trade that people do. So they buy the yield throws off the dividend. The dividends pay for their margin interest. Their margin interest pays down and then they lever up, you guessed it, the Metas of the world, the Googles of the world. So what happens if you get the mother of all forced seller calls? They're going to you and saying, yeah, we don't care that this is paying 7-8%. It's got to go. Yeah, this big trade that you had on that was holding forever, it's got to go. They just start liquidating you. And this is the problem that you have in forced markets because you'll see things, I'll give you one, where Harley Davidson's trading under tangible book value. There's a bunch of these names. You can go and search for them. And we could argue, well, this part's made in Taiwan and people don't like it. Whatever, man. The parts are worth more privately right now if someone bought Harley. And that's why it bounced the way that it did. Some of these other names out there as well, the home builders have a bunch of them now. But they're under, if I bought all of it and liquidated it, I'm undervalued. And the forced selling that I showed you with the Sienna trade makes this irrational and provides huge opportunity. You just have to wait for the forced selling to stop. So what's working in this environment? I'm going to give you a quick tip that I think anybody can use this week. For me, it's going to just be volume. So if I have a 20-day moving average on this, and on this chart, I'm going to use a 5-minute moving average. This was a trade that we did in the community where we just watched it get above here. You can see the volume following through. anytime and you can just eyeball it, anytime you're above the 2x of that 20-day, you want to pay attention to it, especially when it's not in the first 5 minutes. When you start seeing it over, you're going to see squeezes like this, most likely this week or certainly next week. If it's not this week, where people are just going to start getting squeezed on names. So you can see how in here it's set up perfectly. There was actually on a 1 minute bar, there was another trade there. But when you start seeing these areas and you're getting over those 2X's, it's providing huge opportunity. And it doesn't need to just be the first couple of days. Some of the best trades I had is when nobody was looking at this thing. They were just a lot easier trades. So when we look at like NMAX here, and we can see like right in this area, you can see the buyers spike over that line, and it's just the middle of the day. And you can actually even see it here. I was too busy doing other trades, but you see how it's like dead in here, and then out of nowhere, you just get this huge spike in volume. You do the little pullback, and then that's it, it's on, and you just see it from there. But in here, we actually did this. I think I can just show it to you. Here it is. What we're doing on those is we're just finding areas of interest, right? And they're quick trades. They're not short. They're not long-term trades. I'm not buying Newsmax forever. I mean, that's pretty clear. Not at these prices, but a lot of buying previous close, watch it, and then just tells you where we're buying it at, and then what I'm using as my stop, and then I'm telling you how I'm going to trim, and then go from there. So on that move, we're pulling up $5, and then what we're doing with it is just getting out of the way and putting the stop to break even, which is not the worst strategy to do in this market because you don't know how long some of these things are going to go for, especially some of these newer issues. But then you can see it starts up again. And once it starts up again, that's really all you're looking for. You're looking for that other entry. And I think that this is where, to me, people make a mistake on these kinds of names, where they don't go back to the well. And I do go back to the well. So what we start doing is just monitoring it again. I'll just make that big. So you can see it's at 1253. You can kind of go into your chart here and go, oh, okay, I can see what's going on in here, and you can start seeing it picking up. You can see it like right in here. There it is. And so you're just watching it and you're like, okay. And then you can obviously see that the goal is to try to get in before this stop. There's a couple different ways to do that. What I did in this case was I dropped to a 1. And I wouldn't suggest doing this, but sometimes you can catch this stuff. So you see like right in here, this buying and how you're over 2X right in there. And it's not really doing anything, meaning I can't break this level anymore. You're holding that level, which kind of ties directly into what? A previous close area of interest that you were unable to break since it happened once you got above it, meaning resistance becomes support. Using previous closes right now are like they're the cat's pajamas, if the kids still say that. But in this area, it presented another opportunity. So we took it. I'll show you this. And what we're trying to do is we're trying to get ahead of the spikes. And so what we're doing is we're buying it at 118, and these are just the timestamps because I don't like doing this without you guys saying it. So I couldn't figure out where I wanted to stop. So I'm like, okay, well, maybe I'll just put it like directly right under this area, and then we'll go from there. And then what we're doing is I'm just trimming into all this over and over again. So from where we were in at some point, we're pulling stuff out at 61, 63, 67, and then I'm down. And then I'm just waiting for my rejection. I could do exit strategies at a different time. But for time's sake, these are the kinds of things that are working right now. And what you're doing is you're pulling money out, you're hitting your single or whatever you want to call that, and then you're getting out of the way. That's really important right now. The other flip side of that is to start asking yourself questions. Like, for example, you look at something like Apple, and everyone's out there bashing Apple right now and saying, oh, well, they with the iPhones, and 90% of their stuff is in China, and no one's going to pay up for an iPhone, and they're going to be $5,000 if they're in the country. Okay. So if I look at something like that, and this time it's different. That's my favorite line. We've never experienced anything like this. Okay. Like as soon as someone says that to you, just run away screaming because there's nothing new under the sun. It's always the same thing. And people are always going to react the same way and just tell you that there's nothing new. Like, yeah, great. We never had a pandemic. Thank God. But when we had it, the way everybody reacted was the same. Outright fear. It's the same soup reheated over and over again. I just find it interesting that when Apple gets near this 200-week moving average, most people would look at this over like 10 years and say, geez, that was a pretty good spot to buy it. But instead, what we're seeing is the same behavior repeated by humans over and over again, which is where they panic and say, boy, I better get out here before it goes to zero and no one ever buys an iPhone again. One of these ways is a great way to make money. Another way is a great way to lose money. So thinking about this from a barbell perspective, where you're looking at stuff on super short term, is really where you want to be. You know, if you're waiting here, guys, for like, oh, the 5's got to flip and then it's got to curl up and then like, I'll be selling to you. I'm like, in all seriousness, I'll be selling to you. Like, you're going to miss those short-term moves. And if you're looking at this from a standpoint of, I want to look longer term, you have to start looking at these names and saying to yourself, like, at what level would I really buy Apple? And am I a long-term investor? And if you're not, don't do this. Don't say you're a long-term investor when you're a swing trader because you'll get run over. But you have to look at this and say, at what level do I really want to start getting involved? You know, or is Apple dead because of tariffs? Because everybody's going to have them, right? So it's not like Apple's the only phone company in the world that's going to have tariffs. I mean, if you think about it that way, unless we're just going to go back to, you know, 2 cans and a string and an abacus. That's it.